Good morning. It's Tuesday, the 14th of May, and this is Govindraj Ethiraj broadcasting and streaming from and headquartered in Mumbai, India's financial capital, facing unusual dust storms and rain on Monday. Our top stories and themes for the day. The stock markets go on a fresh roller coaster ride, set for a smoother ride in coming days. Emerging markets are looking good again after almost a decade, and why India could benefit. Inflation levels are steady, but vegetable inflation is not. Car sales hit records in the last financial year, but could this trend continue this year too? India and Iran sign a deal to manage a terminal at an Iranian port.
This is a core report with Govindraj Ethiraj.
The markets are on a roller coaster ride once again. It was a roller coaster ride in the stock markets on Monday, otherwise a slow news day, as most Mondays are. Of course, this is relative. The markets struggled to make sense of more election-linked signaling, including a statement from India's Home Minister Amit Shah during the day on Monday, asking, presumably, investors to buy before June 4th because the markets could rise on that day. June 4th, as you are aware, is the day votes will be counted from India's 2024 general elections and results will be declared. Mr. Shah's day job is managing India's internal security. That the markets will zoom on counting days, of course, contrary to what the markets are expecting, including those who firmly believe that the BJP will return to power with a convincing majority. Now, be that as it may, the markets did shoot up on Monday after cracking almost 800 points during the day. The Sensex closed at 72,776, up 112 points, and the NSE Nifty 50 shut shop at 22,104, up 49 points. The Nifty 50 has lost about 3% in the last 6 sessions after hitting a record high on the 3rd of May. Tata Motors was down 8% in its biggest single-day drop since February 2022 on lower margins for its Jaguar Land Rover business and competition from hybrid cars, eating into both its internal combustion engine or petrol and diesel cars, as well as popular electric cars, of which Tata Motors has a dominant stake. More on cars and how they're doing later in the show. The Nifty Volatility Index was higher for the 13th straight session. The fear gauge, as it's called, added 213 basis points on Monday to end at 20.6, the highest since October 2022, according to Reuters. And Mumbai, as I said, saw a dust storm, and 3 people were killed and several injured after a hoarding collapsed in central Mumbai following those heavy rains and gusty winds. Several people were actually feared trapped under that hoarding, and an operation was underway to rescue them overnight. Retail inflation is down, vegetables are not. India's retail inflation eased marginally to hit a 11-month low of 4.83% on an annual basis in April, as against 4.85% in the previous month, according to data released Monday evening. A Reuters poll of 44 economists had estimated the number to come down to 4.8%. So there is a difference, of course, but it's marginal, and it's, of course, down compared to the previous month. The problem, as we've been discussing here on the core report, is vegetable inflation, which stood close to 28% year-on-year, similar to the month of March. Inflation rates for cereals and pulses, which obviously constitute a significant portion of India's staple diet, came in at 8.6% and 16.8%, or almost 17%. Cereals include rice and wheat, and pulses include the dals, which are running at 17% inflation or close to it. Some other data points like fuel and light inflation were down, and so were categories like housing and clothing and footwear. Bank of Baroda Research put out a note saying heat wave effects have just about been seen in vegetable inflation at 28% and will get exacerbated in May too. Cereals and pulses, says BOB Research, will continue to witness high prices until the next crop comes in, and any changes in the downward direction will be more due to base effects rather than the prices coming down as stock levels come down in the market. Emerging markets are picking up after a long pause. Domestic investments are strong, but foreign portfolio investment is important too for the trigger effect it has, and obviously an important counterbalance if domestic starts selling at any point of time now. The interesting thing is that emerging markets are picking up as a category. A research report from ASK Private Wealth in Mumbai says that after a somewhat prolonged period of underperformance, things seem quite well positioned for a breakout in emerging market equities. The report, authored by Dipankar Mitra, Director Research, and Somnath Mukherjee, Chief Investment Officer and Senior Managing Partner of ASK Private Wealth, says that over long periods of time, emerging markets have been at par and often outperformed the US or the developed markets. The real underperformance, they say, is from 2010 onwards, when emerging markets actually drastically underperformed. The key reason for this, they say, is that earnings growth has lagged the United States. The other reason, and this is important, is a strong dollar, and usually emerging markets perform well when the United States dollar is weak and vice versa, which of course makes the current rise interesting because, as you know, the dollar is quite strong, and it's not just in India, but all emerging market currencies which are under pressure. And I will come to that in a moment. ASK says companies growing earnings by at least 10% or more represent more than half the index in emerging markets, and a higher proportion of that emerging market index weight is in companies with more than 30% earnings per share growth when compared to the US market. So right now, as we discussed yesterday, FIIs or foreign institutional investors are selling, having sold almost 17,000 crores in May already compared to March and April when they were net buyers. Now, that's not a trend indicator by any stretch. But if EMs are looking good now and things settle down after election results are out on June 4th, there could be stronger and steadier flows, at least is my sense. I spoke with Somnath Mukherjee of ASK Wealth, and I began by asking him how he was projecting non-domestic or foreign flows.
It does matter. Foreign flows are a very important part of flows into India, has been for a very long time, since the early 90s, when institutional investors were allowed to invest in the listed Indian markets first. At the margin, gradually domestic flows have started getting as large, if not now, significantly larger from a flows perspective compared to foreign flows. And as of very recently, it would seem like that even from a stock perspective, domestic institutional investors dominated by mutual funds in that category today are almost as large, if not slightly ahead of foreign portfolio investors in terms of stock of holdings. So what has happened is that India's fate in terms of the market has been, over the last few years, immunized from the vicissitudes of foreign investor sentiment. And that is, of course, determined by a whole host of global as well as regional factors. And to a large extent, India's market fates are now determined by domestic investors. So foreign investor flows remain extremely important and can make the difference between outsized performance versus subdued performance. But it is no longer the case as it used to be till maybe 6 or 7 years back, when if foreigners sneezed, then the whole market caught a cold. So that's sort of behind us now.
Right. So let me pick up on a couple of points from that. So first is emerging markets, the category which India has traditionally belonged to and continues to when it comes to determining where those flows will go from the view of those investments or funds that are sitting in either New York or London or wherever. So what has been happening in that space in the last few years and what is happening right now?
Funnily enough, memories in general are short, and in the markets, shorter still over the last few years. Generally, the broad sense that most people have is that emerging markets are a clear laggard and has been falling behind performance in the US market, especially for a very long time. Actually, that's a very recent phenomenon. That's probably a last 4 or 5 year phenomenon. If you look at the 21st century, 2001 onwards till the end of 23, equity market performance, index to index, S&P 500 versus MSCI emerging markets, the performance hasn't been very different. It's broadly in the 7.5%, 8% range in US dollar terms. And for a very long time, emerging markets was significant periods of time, emerging markets outperformed the S&P 500 as well. It's only in the last 5 or 6 years that emerging markets has taken a significant hit. To a large extent, that has been driven by the massive underperformance. In fact, forget underperformance, the massive drawdown in China equities, predominantly driven by a host of regulatory and political factors that have played out in China. If you look at it ex-China, the market performance on the emerging market side has not been bad. Even in the year 2023, when there's been such a strong recovery by the US markets, led by the Magnificent Seven, Nasdaq, and also the broader markets, S&P. If you knock off the impact of China, MSCI emerging markets have done not too much behind the S&P 500. The numbers are broadly mid-20s for S&P 500 and early 20s for MSCI EM ex China. So emerging markets as a category, as an investment category, has been dragged down predominantly on account of China, but it remains an extremely important and attractive category for investors to dip their toes in. After all, India too is part of emerging markets and now a very large part of the basket itself.
21%, right? So at this point, you're arguing, Somnath, that we are seeing a turnaround in the emerging market basket or the approach to that emerging market basket. And this is happening after a few years, as you pointed out earlier. So what's triggering this turnaround at this point?
Beginning of this year, the tactical trigger was essentially US rate cuts, when everyone thought that whatever did not happen as expected in 2023, as far as US rate cuts are concerned, is going to happen in 2024. But now that we are nearly 5 months down the year and rate cuts are seemingly, disappearing in the horizon, markets have held up quite strongly, including in the emerging markets, as well as flows. China itself has undergone a smart recovery, but that's very marginal given the extremely cheap valuations that Chinese stocks trade at. But in general, a few things have acted as tailwinds. One has been the far better than expected macro performance of the US, which has meant that global exports have remained quite robust. Now, a lot of the trade data gets skewed by commodity prices, but generally, ex of commodities, global trade has remained quite good, and China has also been a beneficiary of that, as has been a range of other emerging markets that are more export-oriented in nature. Second, domestic policy, monetary policy in Asia especially, and increasingly in LATAM as well, have been a lot more supportive compared to what we have seen in developed markets, certainly in the US. So we've seen a range of emerging market central banks already either cutting rates, as in China, as well as some central banks making extremely favorable noises towards cutting rates. And that's sort of keep both markets as well as consumption in many of these emerging markets at an even keel. Again, supporting stocks and companies. Last but not the least, and that's probably the most interesting and important point there, the pool of companies that generate supernormal profit growth in the emerging market segment is actually a wider pool of companies than what exists in the US. A broad sort of estimate is that close to 23% of companies demonstrated over the last 3 years, which is post-COVID or including COVID, 2020 to 2023, 22% of all companies in MSCI emerging markets generated a 30% EPS growth. That number compares to less than 20% in S&P 500. So there's a very large pool of companies in the EM universe that are actually doing very well. And many of them, ex of India, are available at much better valuations than the garden variety darling of investors, sort of US stocks. And hence, there is, I would say, a confluence of factors that is pushing emerging market stocks and interest in emerging market stocks today. Again, lower valuations, great earnings potential, and the fact that people are looking for pockets of value in a world where nothing that is worth owning is available for cheap.
Are you also investing, or do you invest your clients' funds in the emerging market universe that's outside of India?
Yes, we do.
Okay, so now we are currently poised ahead of the election results on the 4th of June. There has been some jitteriness in the market, which may or may not go away before that. But my larger question is, usually, I guess investors will return once the results are out and so on. What's your sense? Will foreign institutional investors who've been selling quite extensively in May, will they return in the near term? And what's the longer term, at least including in the context that we've been talking about, looking like?
Some of it is simply markets taking an excuse to create a base. A lot of the stocks in the investable universe, India is a very complex and large market, like India as a country, 5,000 stocks that are listed. But the investable universe is a lot smaller. If you look at the investable universe, as I said a brief while earlier, nothing that is worth owning is available for cheap. They're either fair or they're expensive. So it's a continuum between the two. And there is also seemingly a little bit of fatigue coming in fairly large parts of the market on both earnings as well as top line growth. Certainly on the consumer side, there is significant fatigue visible on top line growth. And a lot of the profit growth has been over the last 2-3 quarters has been a function of increased margins. And that's in a very broad, generic nutshell is the difference between the CPI and the WPI. There is a certain amount of nervousness around that. And that's actually more of a bottom up nervousness on how much this jaw between CPI and WPI can continue supporting earnings growth in a scenario where top line growth. So part of it is simply a recalibration back to some level of base after a fairly breakneck kind of rise over a significant period of time, especially in the smaller companies segment. Part of it obviously is related to the elections and whatever political outcomes come out of the elections. Though if you look at India since 1991, and I keep 1991 as the pivot, like everything else in history of India, everything to do with economy and markets, 91 is really the pivot. If you take that as the pivot, there has been a rather weak, if not any, none rather, causal correlation between political alignments and market outcomes. Markets have generally performed irrespective of what political alignments come into power, whether in the center or in major states.
The lens that we've used or you've used in your report and we've talked about so far is the lens of foreign portfolio investors emerging through the or rather investing through the emerging market route. Does that lens in any way change in the next few weeks is my question, or likely to change?
I think a bigger factor, while there might be, depending on the outcome, there will be some knee-jerk sort of very short-term reaction, but a longer or slightly longer-term variable on foreign flows will be US Fed action. I think that has a much higher bearing on flows, foreign flows into India than political outcomes out of election, which will have a temporary sort of reaction, but I doubt whether it will have a very longer term reaction. If the US Fed does not, as it increasingly looks like, does not cut rates this year, that certainly at the margin has an impact on flows.
Right, right. Somnath, thank you so much for joining me.
Thanks, Govind.
India's car sales are strong and waiting periods are down. Car sales for the last financial year was strong and the trend is continuing into this year as well. Data from India's car dealers is suggesting. Last year, sales stood at around 3.9 million cars, around 8.5% higher than the previous year. Interestingly, sales are rising because more vehicles are available, which means all manufacturers have either increased capacity, which they have, or are producing more because supply chain bottlenecks have been resolved. The net result is that waiting times are down in dealerships, and except for a few models, most are available off the shelf. Now, there are a couple of models which still have waiting periods, and we'll come to that, but the wait times are no longer what they were, those absurd 1-year and 2-year waits. And of course, SUVs now represent a market share of 50% of all passenger vehicles sold in India. I reached out to Manish Raj Singhania, president of the Federation of Automotive Dealers Association, based out of Raipur in Chhattisgarh, and I began by asking him how he was seeing the trends for 24-25 or the current year continue in the context of the highlights of the last financial year.
Last year gone by was a fantastic year. In fact, it was fantastic both for PV and two-wheeler. Till now, the PV segment, passenger vehicle segment, was enjoying the ride and the hay time kind of, and we saw bookings going up to 2 years. Now all those bookings have come down substantially and only few models, or not even models, I should say few variants are now in booking, which has to be booked at the dealership. Otherwise, more or less, all models are available at the dealership. But definitely, yes, PV created an all-time high retail figure. We have kind of created a Mount Everest in terms of retail for the PV segment. What was good about 23-24 was the story of two-wheeler. Two-wheeler dealers were struggling continuously post-COVID, and we could not garner some decent numbers. With eventual kind of reform, increasing MSP, good crop, everything is now, and the Manrega, various rural work, I should say, laid down by the central government, has now kind of slowly worked some magic there now. And we are seeing post-festival season, I mean to say last Diwali, we are seeing a positive trend in two-wheeler retail movement. So now what we were talking about, that Bharat of India, the rural market, was not participating in the overall growth story of India, but post Diwali, we are seeing a continuous growth in two-wheeler retails. In fact, last month, two-wheeler retails registered a stupendous 34% growth. So it has been a good year for overall auto industry. As we come to the next financial year, that is the FY25, it has started very well. In fact, April month created another record in PV, and we did an ever highest April month retail for passenger vehicle. So that's another good story, good start for this year. And two-wheeler, as I already shared, it was a growth of 34%. In fact, people were commenting that probably, Navratras fell in April this time. Also, we had this marriage season. But even if you combine March and April last year versus this year, overall auto industry saw a growth of 11%. So that's a very decent start for this auto industry.
I'll come to two-wheelers and also electric, which I want to ask you about. But before that, you said most models are now available off the shelf. So why is that? Is it because capacity has stepped up so much, or is it demand on a relative basis?
Both demands is maintained continuously overall, and with the disturbance in supply chain, we saw a lot of hue and cry there. But over a period of time, everything is now stabilized. Manufacturers are able to be. We always cried about that they are not giving the right models and which is required by the consumer, which is booked at the dealership. But now everything seems to be in perfect flow, and the booking periods have come down to 1.5 months max.
Can you give me an example of a couple of models where, let's say, the waiting list or waiting period was long and then which has come down now sharply?
All SUVs, if you talk about, they commanded a waiting period. I think maximum went for XUV 700 and Thar. That was over 2 years. So all this has now come down substantially. Now, in fact, Thar, only two-wheel drive variant is in a good waiting period still. Rest of the four-wheel drive is more or less easily available. Top model of 700 is at waiting period, but more or less other models are available at the dealership. Toyota still continues to, because of their initial hybrid catch that we are seeing, their model continues to command a waiting right now.
So, and what are the waiting periods for all these models roughly?
Toyota still commands a waiting period of 4 to 6 months. Thar two-wheel drive is 2 to 3 months.
We've been seeing, obviously, electric market growing as a whole, but within that, and hybrids, which you already referred to, has grown faster. As a matter of fact, it's overtaken electric. But what's your sense on how electric is doing in the last few months, particularly post, let's say, in 2024?
See, everything is going good. Overall numbers, if you look at it, but still at FADA, we monitor the penetration. I already shared with you that three-wheelers have been leading the charge of electrification of India. The penetration is anywhere between 55 to 60% there. But if you come down to two-wheeler and passenger vehicle, the two-wheeler definitely in March and we had a higher penetration of almost double digit because that was the last month of the FAME 2 subsidy. And subsequently, subsidy went down by almost one-third support. So, no doubt, FAME 3 is due to launch, but the penetration then further went down to almost 4.5%. So, penetration is overall still hovering for two-wheelers at 5 to 6%, and four-wheelers it hovers around 2% to 2.5%. And volumes are very low in passenger car. So, I think there's still a long story we have a long path to trade here. We need a lot of models and affordable models in the EV segment, whether it is two-wheeler or passenger car, to make it a success story in India.
At this point, we've also seen the withdrawal of subsidies of 10,000 rupees is the subsidy available for two-wheelers, about 50,000 rupees for three-wheelers, and about 1.5 lakhs for cars, all of which has gone right now.
Yeah, so EV two-wheeler subsidy, FAME 2 subsidy was 22,500. It has come down to 10,000. Three-wheeler, 1,11,000. The subsidy has come down to 50,000. Passenger car, there was a support of 1,50,000, which has come down to zero. This will be effective till 31st of July. We have to see what the new government comes in and plan for the electrification of India.
So the reduction in subsidies is affecting sales?
Yeah, definitely. There's a high price point now, and the market needs to get adjusted, and people kind of know there's a FAME 3 subsidy that would eventually come in when the new government comes in. So they will tend to avoid buying vehicles during these times unless and until it is very necessary. So they would tend to avoid vehicles. We will not see a rise in penetration here. They would wait for good support from the central government and for this scheme.
Right. Manish, thank you so much for joining me.
Thank you, Govind. Thank you.
Meanwhile, sticking to cars, President Joe Biden will quadruple tariffs of Chinese electric vehicles and sharply increase levies for other key industries this week, according to Bloomberg. The total tariff on Chinese electric vehicles will rise to about 102% from about 27% right now. The number of actual cars affected may not be much, and the United States is also working on cracking down on connected cars, including obviously from China. So there are several efforts at play here. But the whole idea of increasing tariffs, and that too at such levels, is obviously interesting and is worth following even from here. Bloomberg says Biden's plan for more tariffs is mostly symbolic, as China does not rely on US consumers for the targeted sectors. India and Iran sign a deal for a port terminal. In another shift in the increasingly intricate geopolitical equations of our times and in the region, India and Iran on Monday signed a long-term contract for the operation of the Shahid Beheshti port terminal at Chabahar in Iran. The contract was signed by India Ports Global Limited and Ports and Maritime Organization of Iran in the presence of the Ports, Shipping and Waterways Minister Sarbananda Sonowal, according to a series of posts on Twitter by the Indian Embassy in Iran, according to Business Standard. Now, this is the first time India will take over the management of an overseas port. The minister said Chabahar is not only the closest Iranian port to India, but it's also an excellent port from a nautical point of view. Now, this has, of course, been going on for a long time, and India has been pushing for the Chabahar port project to boost regional trade, especially for its connectivity to Afghanistan. The Ministry of External Affairs has allocated 100 crore rupees for the Chabahar port for 24-25. Iran and Israel, as you're aware, were firing missiles at each other just a few weeks ago, and tensions in the Middle East are obviously at levels not seen in many years. India and Israel also have close ties, both politically and in business. That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in, and thank you once again for listening.